Welcome to the Rudick Report. Today is March 13th, 2023. It's been quite a busy weekend with bank failures stealing the spotlight. On Friday, we watched the second biggest bank failure in U.S. history. The collapse of Silicon Valley Bank sent tremors throughout the financial industry, with depositors scrambling to see if their accounts are insured or accessible, as regulators seized control of the bank and permanently shutting it down, taking control over its deposits. As of the end of last year, the bank had $175 billion in deposits, and approximately $151 billion of those deposits were uninsured. This is beyond insane to me in the first place. If you know that each account is insured for up to $250,000, then why would you keep any more in that account knowing full well that any money in excess of that amount is in danger of being lost? The collapse of SVB, a key player in the tech and venture capital community, leaves companies and wealthy individuals largely unsure of what will happen to their money. The CEO of Y Combinator, Gary Tan, said that what we are looking at is an extinction-level event for tech startups. This is going to have huge implications for the entire tech sector moving forward. It was the largest United States bank failure since the financial crisis of 2008 and the second largest bank failure in all of U.S. history. As of the end of December, Silicon Valley Bank had $209 billion in assets, with more than $175 billion in deposits. SVP deposits are insured up to $250,000 per depositor, just like other FDIC member banks. It covers up to $250K per depositor per bank for each account ownership category. The FDIC stated that uninsured depositors will get receivership certificates for their balances. The regulator said it will pay uninsured depositors an advanced dividend within the next week, with potential additional dividend payments as the regulator sells SVB's assets. Whether depositors with more than $250K will get all their money back will be determined by the amount of money the regulator gets as it sells Silicon Valley's assets, or if another bank takes ownership of the remaining assets. There are worries in the tech community that until that process unfolds, companies may have problems making payroll. This is going to be a huge problem as the vast majority of deposits within SVB exceed the $250K threshold and were uninsured. Personally, that is the blame of the account holders as they knew the risks. It is just a rookie mistake and they may pay a steep price for that lesson. While the FDIC noted that SVB had $175 billion in deposits as of December 31st, the majority, estimated at $151 billion, are uninsured, which means they get zero. However, it is highly likely that a good portion of them have already pulled their deposits in the last few days. As the SVB assets are liquidated, with any luck, those that had uninsured deposits at SVB will eventually see some of their money, but for now, many of them are facing a complete and total nightmare. There are thousands of U.S. startups that banked on SVB, often as their sole bank with deposits exceeding the $250K FDIC limit. The biggest issue is these companies will not be able to make payroll. This means huge layoffs within the sector and some companies folding before the FDIC completes its receivership. When the news of what was being done to Silicon Valley Bank hit Wall Street, bank stocks started falling sharply. Is this the beginning of a new crisis for the financial industry? Michael Burry, the eccentric investor featured in the 2000 film The Big Short, warned, "It is possible today we found our Enron." Billionaire investor Bill Ackman said the U.S. government should consider a highly dilutive bailout of Silicon Valley Bank amid jitters about its financial position. The bank's failure could destroy an important long-term driver of the economy as VC-backed companies rely on SVB for loans and holding their operating cash, Ackman said in a series of tweets on Thursday. If private capital can't provide a solution, a highly dilutive government-preferred bailout should be considered, he said. Once the dominoes start falling, it will be difficult to stop the process. In fact, the situation is already so alarming that Peter Schiff is stating the following, quote, "The U.S. banking system is on the verge of a much bigger collapse than 2008, said economist Peter Schiff. Banks own long-term paper at extremely low interest rates. They can't compete with short-term treasuries. Mass withdrawals from depositors seeking higher yields will result in a wave of bank failures." Of course, a lot of the experts in the mainstream media never saw this coming. Just last month, CNBC's Jim Cramer was actually telling his viewers that they should buy SVB stock. SVB's situation is not unique. Thanks to rapidly rising interest rates, many other banks are also sitting on mounds of treasury bills that have lost a lot of their value. Banks are big investors in assets like treasury bills where they need a lot of safe places to park their cash. Many financial institutions piled into these investments during a period of historically low interest rates that spanned the early years of the pandemic, as banks took in tons of new deposits and lending was somewhat restrained. But now the Fed is hiking rates rapidly, with Fed Chair Jay Powell warning that they may have to speed up the pace at which the rate hikes take place to slow the economy down. The problem that creates for banks is simple. Higher rates lower the value of their existing bonds. The truth is, our financial system simply cannot handle higher rates. People are barely holding on, as most Americans are living paycheck to paycheck. Who knows, with the majority of these SVB accounts not being insured, maybe some of these wealthy businesses and business owners will be living paycheck to paycheck just like the rest of the Americans. Regardless of how this unfolds, the White House is bound to do damage control and try to stop bank runs, which will inevitably happen as people start pulling their money out of the banks. Also, be aware that just a few days before the crash happened, the CEO of SVB cashed out a few $1 million and bonuses were paid as well. This fractional reserve banking system is going down. So if the banks take in $100, they keep 10 and lend out 90 to others. As with all our messages, this one is no different, and of course, this is not financial advice. They are taking this system down. So get extra food, get water, get cash for emergencies in case of a bank run, and if possible, get out of debt and move some money to precious metals. There are many reputable companies to buy from. Some include JM Bullion, SD Bullion, and Money Metals, but you can use whoever you think is best. But just take some action before you can't. Thank you for listening. If you found value in this report, please like and subscribe, and if you are able, please visit my affiliate links to support this channel. Your help is greatly appreciated. Until next time, this is the Rudick Report.